Most beginners enter the stock market with unrealistic expectations, fueled by viral success stories and influencer hype. But the reality is far more mechanical, disciplined, and unglamorous than what is shown online. Making millions in stocks is not about luck, timing the market, or finding the next big thing. It is about mastering a repeatable system based on valuation, patience, and emotional control. The first step is unlearning the myths. You do not need insider information, you do not need to trade daily, and you certainly do not need to predict economic crashes or booms. What you need is a strategy that survives volatility, compounds over time, and aligns with your risk tolerance, not your dreams. The people who actually build wealth in the market are not the ones shouting stock picks on TikTok. They are the ones quietly reinvesting dividends, buying during downturns, and ignoring quarterly noise. If you are serious about turning small capital into real wealth, you must accept that this is a 10 to 20-year game, not a lottery. The math is simple. Consistent returns of 10 to 15% annually, compounded over decades, will turn modest sums into millions, but only if you avoid catastrophic mistakes like leverage, panic selling, or chasing momentum. This is not motivational fluff, it is arithmetic. And arithmetic does not care about your feelings, your FOMO, or your Twitter feed. The stock market rewards those who understand its rules, not those who try to break them. If you are still here, you are already ahead of 90% of beginners, because you are willing to face reality instead of fantasy. Building real wealth in stocks is not about picking individual winners. It is about constructing a system that captures broad market growth while minimizing behavioral and structural risks. The foundation of this system rests on three pillars: asset allocation, cost efficiency, and tax optimization. Asset allocation means deciding what percentage of your capital goes into equities, bonds, cash, or alternatives, and sticking to it regardless of market sentiment. Cost efficiency means using low-fee index funds or ETFs whenever possible, avoiding active managers who statistically underperform after fees. Tax optimization means holding assets in the right accounts, tax-deferred versus taxable, and minimizing turnover to reduce capital gains liabilities. Most self-made millionaires in stocks did not get rich by outsmarting Wall Street. They got rich by avoiding Wall Street's traps. They did not pay 2% management fees. They did not trade in and out of positions based on CNBC headlines. They did not try to time recessions. Instead, they bought quality assets, held them for decades, and let compounding do the heavy lifting. The S&P 500 has returned roughly 10% annually over the last 90 years. That is enough to turn $10,000 into over $1 million in 50 years. You do not need to beat the market, you just need to stay in it. And staying in it requires a framework that removes emotion, automates decisions, and survives your own worst impulses. That framework is what separates investors from gamblers, and millionaires from the broke crowd. The single biggest obstacle to building wealth in stocks is not lack of knowledge. It is lack of emotional discipline. Most beginners fail not because they picked the wrong stock, but because they sold at the bottom, bought at the top, or abandoned their strategy after 6 months of underperformance. The human brain is wired for short-term survival, not long-term compounding, which is why market downturns feel like emergencies, even when they are statistically normal. Successful investors train themselves to see volatility as an opportunity, not a threat. They do not check their portfolio daily. They do not react to quarterly earnings misses. They do not panic when the talking heads scream crash is coming. Instead, they follow pre-defined rules. Rebalance annually, add capital monthly, ignore macro noise. Behavioral finance studies show that the average investor underperforms the market by 3 to 5% per year simply due to bad timing decisions. That is the cost of emotion. To overcome this, you must systematize everything. Automate contributions, set buy and sell triggers based on valuation, not sentiment, and create a written investment policy statement that you review, not rewrite, during turbulent times. The market does not care about your anxiety, your rent payment, or your Instagram envy. It only rewards those who can detach emotionally and execute mechanically. If you cannot control your impulses, no strategy will save you, no matter how brilliant it looks on paper. Master your psychology first, the returns will follow. If you are starting with limited capital, your priority is not maximizing returns, it is minimizing mistakes. Your first $1,000 should not be gambled on meme stocks, crypto, or penny stocks. It should be used to build foundational positions in low-cost, diversified instruments that give you exposure to global growth without single stock risk. Start with a total market index fund, like VTI or VT. It gives you instant ownership of thousands of companies across sectors and geographies. If you are in a tax-advantaged account like a Roth IRA or 401k, use it to hold equities. They will grow tax-free for decades. If you are investing in a taxable brokerage, prioritize tax-efficient ETFs and avoid high-turnover funds that generate short-term gains. Never allocate more than 5 to 10% of your portfolio to individual stocks until you have built a solid core, and even then, treat it as play money, not core wealth. Reinvest all dividends automatically. Compounding works best when you remove friction. Set up automatic monthly contributions, even if it is just $50. Consistency beats timing. Avoid leverage, options, and margin at all costs in the beginning. One bad trade can wipe out years of progress. Your goal is not to get rich quick. It is to survive long enough to get rich slowly. And the only way to survive is to start boring, stay boring, and let time turn your discipline into dollars. Boring is the new alpha, especially for beginners. One of the most valuable skills you can develop as an investor is the ability to recognize when an asset is priced for perfection, and therefore vulnerable to disappointment. Valuation is not about predicting short-term price movements. It is about assessing whether the current price reflects realistic long-term cash flows. Learn to read basic metrics P/E ratio, P/B ratio, EV/EBITDA, free cash flow yield. Compare them to historical averages and industry peers, not to hype or narratives. A stock trading at 50 times earnings is not cheap, just because it is disruptive. It is pricing in near-perfect execution for decades, and perfection rarely lasts. Conversely, a stock trading at 8 times earnings with stable cash flows and low debt might be undervalued, even if the company is not sexy. Use screeners to find statistically cheap assets, but never buy based on valuation alone. Always layer in qualitative analysis, management quality, competitive advantage, balance sheet strength. Avoid story stocks, companies with no earnings, no path to profitability, and valuations based on potential. Potential does not pay dividends. Cash flow does. The goal is not to find the cheapest stock. It is to avoid the most expensive mistakes. And the most expensive mistakes are always made when everyone else is euphoric. Learn to be skeptical when others are greedy, and curious when others are fearful. That is not a cliché, it is a survival mechanism. Beginners obsess over returns. Professionals obsess over risk. The difference is what separates those who last from those who blow up. Risk management starts with position sizing. Never allocate more than 5% of your portfolio to a single stock, and never more than 1 to 2% to speculative bets. Use stop losses not to avoid volatility, but to prevent catastrophic losses. A 50% loss requires a 100% gain just to break even. Diversify across asset classes, sectors, and geographies, not to maximize returns, but to minimize correlation during crises. Understand that low risk does not mean no volatility. It means low probability of permanent loss. Bonds, cash, and gold are not boring. They are shock absorbers that let you stay invested in equities during crashes. Rebalance your portfolio annually, not to chase performance, but to maintain your target risk profile. Avoid leverage like the plague. It magnifies losses faster than gains and wipes out beginners faster than anything else. Never invest money you will need within 5 years. The stock market is not a savings account. Insurance is part of risk management too. Term life, disability, and umbrella policies protect your ability to keep investing even if life goes sideways. The goal is not to avoid all losses. It is to avoid losses so large they derail your entire plan. Protect your capital first. Returns will come. Lose your capital and the game is over. Once you have mastered the basics, consistent contributions, low-cost indexing, emotional discipline, it is time to layer in more sophisticated strategies without abandoning your core. This does not mean chasing complexity, it means adding precision. Start analyzing individual companies using discounted cash flow models, not to predict exact prices, but to understand intrinsic value ranges. Learn sector rotation not to time the market, but to tilt your portfolio toward undervalued areas during economic cycles. Consider factor investing value, momentum, quality, low volatility as tilts within your index core, not replacements. Explore international markets, developed and emerging, to capture global growth and reduce home bias. Use tax loss harvesting strategically to offset gains and defer taxes, but never let taxes drive investment decisions. Re-evaluate your asset allocation every 3 to 5 years as your goals, time horizon, and risk tolerance evolve. Start reading annual reports not for stock tips, but to understand business models and management incentives. Build a watch list of 10 to 20 high-conviction ideas, but only buy when valuation and market sentiment align. Never abandon your index core, it is your anchor. Everything else is a satellite. The goal is not to become a hedge fund manager. It is to become a more informed, more intentional version of yourself. Progress, not perfection. When your portfolio crosses 6 figures, then 7, your psychology must evolve or you will self-sabotage. Wealth attracts complexity, temptation, and ego, all of which can destroy what you have built. The biggest risk at this stage is not market crashes. It is lifestyle inflation, overconfidence, and advisor exploitation. Never confuse bull markets with brilliance. Stay humble, stay mechanical. Hire a fee-only fiduciary advisor if you need help, but never hand over control without understanding every decision. Avoid sophisticated products like hedge funds, private equity, or structured notes unless you fully grasp the fees, liquidity constraints, and risks. Keep living below your means. Your wealth is a tool, not a trophy. Reinvest the majority of gains. Do not start withdrawing until you have 25 to 30 times your annual expenses in safe, income-generating assets. Teach your family financial literacy. Wealth without wisdom is a liability. Document your strategy, your rules, your failures, and review them annually. The goal is not to retire early. It is to build freedom, security, and optionality. And freedom is not having millions. It is having the discipline to protect them. If you have followed this path, you did not get lucky, you got systematic. And systems outlast trends, crashes, and hype cycles. You are not a trader. You are not a gambler. You are an owner. And owners build empires, one disciplined decision at a time. If this blueprint made sense to you, if you are tired of hype and ready for a real, mechanical, no BS approach to building wealth in stocks, then do 3 things right now. First, like this video, it helps the algorithm show this to more serious beginners. Second, subscribe and hit the bell, because we are just getting started, and the next videos go even deeper into portfolio construction, tax hacks, and advanced valuation. Third, comment blueprint below. I will reply with a free checklist of the 10 non-negotiable rules every beginner must follow to avoid blowing up. This is not theory, this is how real people build real wealth. Stay disciplined. Stay patient, and I will see you in the next one.